Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Stephen Gattuso, who's a Senior Portfolio Manager and Director of Research over at Courier Capital. And we're going to focus on macro signals to watch for the remainder of 2018. And Stephen, I bet you there's a lot of them that we'll be watching. They all seem to come together. And so let's talk about the number of signals that you are watching for 2018.
Certainly, yes. After a very calm 2017, we're seeing quite a bit in the macro economy and politically that we're watching. And there are 6 things that I'm keeping track of right now. And a lot of them are in headline press as well. So for example, the protectionism and the trade and tariff situation, inflation-driven interest rate rises that might be coming. Midterm elections later this year are a political item that are worth noting.
We had a big announcement this morning as well with Paul Ryan seeking re-election.
Exactly, it just keeps adding to that. We also have housing, which I think is a spot to be watching currently. Corporate earnings, of course, which are expected to do very, very well and are a signal, obviously, for the market of what's happening in the general economy. And then finally, concerned about federal debt and the servicing of that debt.
All right, out of all of them, what's keeping you up at night the most?
The one keeping me up at night is probably the debt servicing because of its implications, especially in a rising rate environment right now and with a ballooning deficit that we're back into right now. And with the current levels of debt being at 20 trillion together and public almost 15, that makes for a recipe for a squeeze in the federal budget, which could just become worse.
Yes.
Housing is also another one that is under the radar but is concerning.
Right, why would you say that?
Well, it's right now the big concern is there is an supply or low inventory driven price increase. Price increases were 6% in the 20-city Case-Shiller Index over the past year. And that's significantly higher than wages. So housing affordability is becoming an issue. If I look at median income versus median home price, generally that was a ratio of 3 to 1. We are now up at 4 to 1. So nationally speaking, affordability is becoming an issue, and we're walking into rising interest rates, which are going to make it even less affordable. We also have the millennials, which have delayed household formation, but they're getting into their early 30s now, so they're at the point where they want to start buying a house. There really isn't quite a bit for them to choose from, especially at the entry level.
Right. So are these all tied together, or are they, I mean, individually there's something that could definitely move the market there, but are these all tied together as a domino effect? If one thing happens, it's going to knock down the next set of dominoes?
Yes, I would agree with that. And I think the one to watch, of course, is inflation and what it does to interest rates. Right now, looking at Fed mandate of full employment, we're really, by some argument, almost there, if not there already, with a 4% roughly unemployment rate. And now that inflation is starting to heat up, we saw a CPI come out this morning, which was a little bit less, but we're still at 2.4% for the year through March. We see PPI yesterday coming up past the 3% number, and we also have the underlying inflation gauge at 3%. So with all of this, the heat up of inflation is starting. That's their second mandate, so again, it's giving them a clear road to raise rates. Currently, they were looking at 3 in 2017, followed by another 3 and 2, which is an increase. But if things stay on the path they're on right now, you can certainly make an argument for potentially 4 in this year.
Well, how important are rising rates to the economy? Because that Fed is focused on the economy, not necessarily the impact that the headlines have to the market, right?
Exactly.
And rising rates would suggest that the economy is improving and it can sustain higher rates. So what are your thoughts around that?
We haven't been at these levels since really 2008. That's all we've had is really a low interest rate environment. So how the economy responds to higher rates is going to be an interesting read. Once we start hitting, if we look at the 10 years sitting at about 2.7, 2.8 right now in that range, if it starts to hit 3%, we're in an area we haven't been in 10 years. So I think you're going to see some 3 effects, actually. It's going to be from a federal standpoint. Again, as I mentioned, we have federal budget deficit that has to be serviced, and that 3%, right now federal debt is serviced at about 2.2%, but those rising rates are going to catch up with that. So you're going to have an impact from a government standpoint and spending. You're going to have an impact from a corporate standpoint because right now corporations have taken on debt excessively in this low interest rate environment, and many of them have done that to alter the capital structure to do share buybacks. So that debt, some of it is floating rate, and they're going to see impacts there too. There's also a tax law impact to having too much debt, so I think that's going to play on to the corporate balance sheet as well. Then finally, you're going to have the consumer. Consumer's going to be impacted by debt in a number of ways, from financing your car to looking for that new house and trying to finance it with a higher mortgage.
All right, and to wrap up, the average retail investor, are they going to be impacted by all of these?
The retail investor is going to be impacted depending on how the economy responds. Right now, if you look at corporate earnings, we're looking at an 18 to 20% increase in earnings per share, but a lot of that's driven by a couple of things. Number one, the tax law driving that corporate tax rate down from a statutory 34 to a 21%, and then the share buybacks also have an impact on EPS. But what we're really looking for is to see what happens with top-line revenue growth and operating income growth. If those start to suffer because of these effects, it's going to play into the market because the market's a discounting mechanism, and you're going to see lower cash flows. So the retail investor would feel it in that respect.
All right, well, thank you very much for joining
You're
us
welcome.
at MarketSite
Thank
today.
you.
Thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.